introduce you to our two panellists. First of all, David Heather. David's the Chief Executive of Managed Accounts, an MDA operator and provider, so providing both technology, licensing and solutions around managed accounts. And the gentleman closest to me here is not Scott Webster. Michael started his week just the way you don't want to start your week, is getting an email from someone saying, "Mate, I'm crook, can you step in for me?" So Michael's had a very comprehensive 15-minute briefing on this, and he is ready to go. So the topic is best execution, and we're going to sort of get into the detail of that in a moment. A bit of quick positioning. The industry, the managed account industry, has had something of a protracted adolescence, and the sort of numbers that Dan was talking about and the sort of numbers that come out of the IMAP survey of the size of the industry is telling us that we're moving beyond adolescence. It's becoming a more mature industry. And some of the discussion this morning was about the sort of responsibilities people take on when they adopt certain roles as an external RE or an internal RE, being a portfolio manager, the sort of obligations that you may have. And to some extent, this chat's a bit like that. It's saying when you're running managed account services and you're delivering them to your clients in a mature industry, what are some of the things that you're thinking about when it comes to execution? And so we're going to explore that topic a little bit. So Michael, for his sins, is the Head of Execution and Clearing Services at UBS. So notwithstanding, he didn't get much of a briefing, he actually does know what he's talking about, and we're going to open the batting by asking Michael, what is best execution in the broking world? You know, is it a formal obligation, and you know, where does it stem from?
Yeah, thanks, Brett. Best execution from a broker sense is that it's actually enforced on us as part of an ASIC regulation. So brokers have an obligation to ensure that we do meet best execution, but you're probably wondering, well, what does that actually mean? So from an in-house at UBS, whenever you open an account, or whenever anyone in this room opens an account with a broker, you'll get your terms and conditions, or you'll also get the best execution arrangements. All right, so everyone should know or what your broker is actually actioning for you. But there's two different types. So there is a retail version and also what we call a wholesale institutional level best execution. So the best way that I can articulate that for you is, and the way we adapt it at UBS is on the retail side, we look at it from a best total consideration. So what is the best total consideration we can get for that trade or execution for the client? And what that encompasses is all the exchange fees, the clearing fees, the settlement services that are also provided. When you look at a wholesale and an institutional level, because of the trade size, and if you look at a retail size client, your average trade is $10,000, $20,000. Moving into the institutional world, what we target there in our arrangements is we target best price. So best price can, depending on the liquidity of the stock, the volume and the size of the trade, will determine what that actual best price is. So there's a number of factors, compared, that institutional level versus what the retail level clients get.
And just to be clear, in terms of a managed account client, they're retail clients, they own the stocks directly, but for the purposes of the way ASIC's going to look at it, the obligation is a wholesale one in terms of
it is a wholesale client.
Yep.
Because we face that we class that as a wholesale institutional relationship.
Yep.
Because of that MDA structure and the legal wrapper structure around it. So it is the second tier that faces that from a best execution size.
Which is a far broader and more comprehensive obligation. Now, David, you're involved in providing the services that enable people to act as portfolio manager, to put trades to market. And from your point of view, I think you're seeing best execution in a sort of a broader way. So tell us, from your perspective, in the managed account context, what does best execution mean?
Look, I think best execution in the managed account context goes beyond just what the broker does in terms of the trade execution component. Toby's just reminded me that I've got a slide here. Thanks. So from a managed account perspective, you've really got three elements that come into play. The trade execution component, yes, but prior to getting to that point, and I'm sure I'll get this going the wrong way. Oh, there we go. There's two components that come together. First of all, there's the managed account platform that actually has all the client data that obviously creates the trade instructions ultimately by virtue of what a manager wants to do at any point in time. And then there's the manager decision, or what input does the manager make to the trade before you actually get to the point where the execution needs to take place. So I think best execution in the managed account world is the integration of the three elements. Manager decision, what the platform can offer, plus what the broker has an obligation. So if we look and see how different parts of the market work in terms of a managed account, I'm sure a lot of people are familiar with an SMA style approach. I mean, I look at the SMA as the manager having input to what a portfolio looks like, because really what you're putting up is stocks and weightings, and the platform actually does the rebalance, and off the back of that rebalance you end up with a trade that goes out to the market through Michael or some other broker. That's quite different to what I consider to be a best execution approach, where really the managed account platform is enabling, if you like, the manager to make a decision on what they want to do today, be it trade or not trade, or to buy an asset at a certain price. And there's a subtle difference there in terms of the manager having the ability to make that decision based on information that the managed account provider provides. So I think there's a subtlety there that needs to be factored into a managed account, purely because the three elements come together in an integrated way to create a solution for the end client.
Very good. So now I'm sort of conscious that often in the industry we have a separation in terms of those who have worked a lot with direct stocks in the past and those who haven't. If you're part of the former group, bear with us just for a moment, because we'll be covering familiar ground. But if you're used to putting a trade on a platform and you say, I want to buy those stocks, the trade goes off, and at some point or another you see in the client's account, presumably 3 days later, that trade's been fulfilled and you're done. But you're talking about manager decisions and the sort of ways they can execute. If we could just talk for a moment about the choices for a portfolio manager if they want to do something rather than just put it to trade at market. So perhaps, Michael, if you could sort of give us an idea as to the options available for people who want to instruct the broker, the sort of things they could instruct you to do.
Yeah, good question. There are many different ways that you can face a client. So one of the ways that managed accounts or direct clients do is electronically. So they will place orders directly via a terminal, whether it's an interface via Iris, Bloomberg, or some other method, and they can place orders directly to us or to any broker. There are other avenues whereby you can go down the traditional worked order route. All right, and that opens up other avenues of liquidity and opportunity for, when you get into the larger MDA providers and large assets under management, when you're moving, millions of dollars worth of stock and you're dealing in small cap stocks or stuff outside the ASX, 30, 50 in that area. It is very opportune to, put it into a worked order flow and have a sales trader looking at what flows are through the market. Is there any market news through the day that would impact, if you're buying or selling that stock, where we can go back direct to the intermediary or to the investment manager and get further instructions on what is the best way to execute that for you.
Right. Okay. So now that can occur through a platform-based trade. I mean, is that available for people using these sort of services, or do they have to be talking to you directly?
No, absolutely. So we connect, as part of my business, we connect into a number of platforms. And it's just working out and working with the client directly. Where did you want your flow to go? So do you want it to become electronic? And we give you, whether you go and put a limit order on, a market order, or whether you then, so from an electronic, we give you an algorithm to work the order yourself, whether it's a volume weighted average price algo or another one within the suite. Or secondly, from that platform, we can direct it into our worked order sales desk, which is completely segregated from the electronic team.
Okay. So that sort of talks to the way that the service that's upstream from you is organising itself and sending you instructions. David, can you talk to us a bit about, from the point of view of being an upstream provider, what you think a well-designed managed account solution incorporates?
Look, I think, and I've just got a slide up there which I might just talk to. In our view, I'm CEO of an MBA provider, obviously, so one might argue that I've got a vested interest in this, but at the same time, I've also seen some pretty poor outcomes from a client perspective and for that matter for the advisor, because they need to obviously explain things to the client. But if you break down what we think best execution is and the best way to design a managed account, I think first of all, the managed account provider has a role to really provide technology processes and data integrity to a manager to actually make informed decisions around what they want to actually do today or do this minute or do this hour on behalf of clients who are in a managed account structure. So, from my perspective, we see the investment manager, whoever that may be, be it a professional manager or an advisory firm or research house or broker for that matter, really undertaking and taking ownership of the trade decision. And I think that's a fundamental difference from the way that a lot of managed account solutions work in the marketplace, which isn't to say that that's not fine. It's a question of whether that's actually getting the best outcome or best execution objective met. So the other thing I think that's important is that the managed account provider itself also needs to give the manager flexibility over what assets are included in client portfolios. So it's a matter of actually saying, right, if you're running an ASX 50 oriented portfolio, that's fine because you haven't got a situation where you've got to worry about volatility as much as you would in a small cap stock. And I think fair to say, if you look across the market, there's not that many small cap portfolios being managed in a managed account structure. I think partly that's because we haven't got best execution across the market as where it should be. So I think there's the same argument you could talk about for hybrids or listed income. Even unlisted bonds. I mean, there's issues you've got to face in that unlisted bond environment that revolve around execution. So principle's the same. So that's how we see the managed account provider as really the architect, if you like, of the technology process and the data. I firmly believe the manager has to make the call. If you're running an insto mandate as a manager or you're running your own fund, you're inherently going to make the call on what assets you trade, at what price you trade those assets. And I think from a managed account perspective, we've all, as an industry, got to get to that level. I think going back in time as managed accounts has been a bit of a child going into adolescent stage. It's been okay for everyone to accept that it's a poor cousin to your existing structure. But I think the fact that so many people here today says that investment managers are now seeing that there's opportunities in this space, and I think everyone needs to step up to the plate and actually do the best thing by the client. And finally, from the broker point of view, I think it's about the manager working with the broker to get the best outcome, not just having a VWAP model or something similar, which really becomes a dumbed down outcome. And I think when we all get to that point, we're really talking about best execution at that point.
So, gents, in terms of the consequences of not having best execution, I mean, you sort of alluded there, David, to the fact that maybe if you can't manage orders, then there's certain assets you're not going to go near. So, potentially there's an impact there for clients. What other ways would end investors be impacted by not getting best execution?
I think the first thing is that potentially clients could be paying more for assets than what they should, or indeed they could even be in assets that they don't really want to be in because the solution that they've been invested through doesn't provide a flexibility to the manager to be able to, for example, hold the client in cash, let alone trade the asset. So I think there's certainly from our perspective, talking to some advisors, they've had some bad outcomes where clients have actually bought into a stock early in the day and all of a sudden there's a market correction and which they had no control over time of execution, and then all of a sudden they've got to explain to the client why they've been invested in a stock today when normally they wouldn't be in that situation if they were running an insto mandate or a fund structure. So I think putting, as I said, putting the decision in the hands of the manager and letting them trade out through their brokers of choice, I think it's a key way of actually ensuring the client gets the best outcome. And for that matter, the advisor. The advisor's the one who has to explain all that away to the client, which isn't a good place to be.
Michael, anything to add there?
Yeah, I tend to agree with David. It's a partnership between the investment manager and the broker. So, on the liquidity of, some of the things we do see in certain models, ETFs, hybrids, small cap stocks, they are challenging to trade. The spreads can be quite significant, and the volatility high, but the volume's low. And if you can actually, on your trading and what you do, you can push prices, which the regulators will. As a broker, we have an obligation to make sure that doesn't happen, and we have filters and policies and processes and framework in place as a broker, and all brokers would, to ensure that doesn't happen. But to David's point, I think the key point there is to ensure that you're communicating with your broker, and you're paying brokerage. Make sure you get your bang for your buck. Don't be scared to pick up the phone. If you can't pick up the phone and speak to your broker, that's where there's a problem there.
Yeah.
Just to make a point, I think there's sometimes there's too much reinforcement of this brokerage is cheap when you trade through a managed account, but sometimes that brokerage actually is cheap for a reason. And I think sometimes the trade call that needs to be made warrants maybe paying a little bit more for the brokerage to actually get the best outcome net for the client.
Is on that topic, is paying, I don't know what the market is for online trades, but let's say it was, $20 a trade or something like that if you get a ComSec or similar. Is that acceptable in the managed account world? I mean, is that a wise pricing model, do you think? Or?
Well, it's a different model because obviously a ComSec model is on a client-by-client basis. Yeah. So as Michael alluded to, you're talking really here about an insto type structure. So what's your experience in terms of what typically...
Typically, brokers, it's all volume based. The more you get through, the more flow. And it's a partnership. Don't get us wrong. We understand that clients need to make money. If they're not growing and expanding and getting bigger, then that's not beneficial for us for a long-term relationship. So, we like to think, especially, you will see from a direct market access or electronic trading, that would be a cheaper price than what a worked order service would be, right? Because a worked order, you're picking up, speaking to a human. They will, reverse inquire, saying, "Look, we're seeing a bit of news on this stock today. Have you changed your limit? Have you changed your thought process? Are you happy to continue along that trading strategy?" So, worked order, you will get charged more. The electronic trading where you're making a lot of the trading decisions, that will be a cheaper price.
There's certain issues that come with this, though, aren't there, David? Like, in my own experience, putting trades where a client will see a report and they'll see, "Gee, you traded the same stock, 3 times over the course of 4 or 5 days." You just look like you're tooling around. What are you doing? Can't you just get the order filled? That people see it as noise on a report. Now, the fact is, you might have had a price target and you've worked damn hard to get them that stock at a price, not paying too much, but what they see is the cost of the trade. They don't necessarily see the benefit. So this is one of the communication challenges, I presume, that comes with sometimes paying a bit more to get the right service and the right outcome.
Well, typically you're going to see that type of scenario where you may be trading in small caps or listed income where there's not as deep a market. So in some respects, it might not just be the fact that you couldn't get it at a price. You couldn't, maybe there's not enough stock.
Yeah.
So it depends on the situation. So I think, at the end of the day, there is an element of difference when it comes to trading small caps or less liquid assets. You've got to accept the fact that sometimes you might not be able to get out as readily as you can, say, a top 50 stock.
Yep.
And sometimes that's just a matter of it's a stock you're trading. So
perhaps if we could turn for a minute to sort of design of services and the notion of best execution, and then looking at individual HINs versus pooled HINs. I don't know what the current costs are exactly, Michael, on cost of a trade, sort of ASX fees, those sorts of things, but $3-4, something like that on a trade?
Yeah, roughly. On the individual HIN model, you will get, obviously from the clearing fees is the kicker. We need to keep the ASX ticking over, so and they do a good job at that. But if you are settling to an individual HIN, if you allocate to a hypothetically 200 client accounts, you're going to get 200 times $1 to settle that trade as a broker. That's the cost of settling that trade. If, for example, if we aggregate those 200, if it's all those 200 clients all got BHP, and we aggregated that into one line to settle to a custodian or for a platform, that's one line for me, and that's $1.60 cost. So from a settlement perspective, there's some significant price discrepancies there. But from a broker perspective, we can connect into, and all brokers will be able to connect into any model that you should be able to want to support.
Yeah.
Brett, if I might just add a comment there. I mean, one of the things we've been seeing across the market as a provider of managed accounts is a desire for some advisors to have a HIN-based model. I think fair to say most solutions in the market have been custodial focused. So we've actually just gone through the process of getting our ASX participation approvals to actually be able to sponsor clients into CHESS and settle trades on behalf of the client, which means for us we can run a nominee model across the top of a HIN structure. So we get the best of both worlds, so we can use the nominee to get out to market, but then still hold the asset in the client's name and be able to achieve that with an institutional rate of brokerage. So we've certainly seen the need to deliver a solution to that part of the market, and that's certainly something where we're hoping to see advisors embrace if they've held back in managed accounts because they don't like custody. And I think a lot of ex-brokers and brokers don't like custody. So that's a new way, I guess, of looking at that solution.
I've got 2 or 3 more questions, but I might just ask one and then we'll open it up, see if there's any questions from the floor. So the sort of the 2 most important issues from your point of view for best execution in managed accounts, what are the areas that you think that the industry collectively should be looking at?
Collectively, from a broker execution perspective, participate across all timeframes of the market. If you can you need to have your rebalance or your trades ready to go before 10 o'clock for market open. If you know how the market works, or and what it does, all the liquidity is at 10 o'clock in the morning. It will dip through the day and then kick back up at the end of the day towards market close at 4 o'clock. That's really, really important. If you can participate it through all levels, you're going to make sure it's an easier conversation to have with your client at the end of the day to say why you got a specific price instead of, I did it at 12 o'clock and the price was down 2-3% of that time. So that's one suggestion. And secondly is make sure you have great communication with your broker. Be clear on your instructions, clear on what you're wanting to achieve and what the outcome you want to do. They're the 2 key points.
Dave?
Look, I think from a broad perspective, we've all got a role to try and make sure that we're delivering the best outcome to the client. And I think to date, it's all been about how simple is the admin in some respects that we're delivering, rather than necessarily about what prices are we paying assets for. So, I'd probably look to the management community, investment management community, to try and step up and take a bit more ownership around what's going on the trade execution side. I think we certainly see some managers out there who have got enough volume behind them now really want to do that properly, and I think they're reaping the rewards from that perspective. And I think from the other side of things, you can go a long way and you can think you're putting clients first, but sometimes you're not. So I think if we all put clients first, then we'll all look at things the right way, and that generally applies for everything that we do in the market these days. So probably two messages.
And so when you're saying investment management, you're thinking about anybody who's wearing the hat of a portfolio manager of listed stocks in a managed account?
Yeah, and not just listed, but there's, I mean, obviously funds is not such an issue, but, any direct asset, I think is probably where my point is.
Right. Very good. Now, any questions from the floor?
Brett. I've got a question, which speaks. We've been speaking about domestic listed here, but I wonder if either of the panellists want to comment on the cost effectiveness of direct execution or direct holding in international listed.
International trading, for my view, might not be the House view, is challenging. There are significant infrastructure and back office requirements to support that type of structure. From a broking perspective, I know the biggest issue that I have for clients who come to me and say, can you do international trading for me? And I say, absolutely. There's a barrier to entry at that point. There's a minimum cost as a broking house that I need to do to open up each specific market. However, the biggest issue I have is I'm not a custodian, all right? So I can't hold the assets. So one of the key challenges in the market is finding, for the smaller players who are starting to kick off, a lot of the custodians won't have a look unless you've got, X hundreds of millions in balances, so they're profitable on their side. So that's the challenge that I foresee. It is, we always hear that the international is the next forefront. I think that's being offset with some ETFs and some other products there. But if I have a look at the international trading through, my business that goes through now, there's only two markets clients realistically want, and that's the US and UK. I have 96% of the flow goes through those two markets. So having a relationship with the custodian and building that is the key challenge that I foresee.
Yeah, look, international is a different kettle of fish totally. Our business as a provider haven't been pushed as hard as some of the other providers to be in the international direct space. From a business case point of view, I think from a portfolio outcome point of view, sometimes it's questionable whether certain clients should be in that type of portfolio, purely because they haven't got enough volume to actually warrant the additional costs that come into play. And I think certainly sometimes a fund or an ETF sort of outcome is a better place to be, but acknowledge that for some clients it should be something that's used. We're talking a different kettle of fish here in terms of cost, and there's firms like Mason Stevens and Implemented Portfolios and others that I know have gone down the international space, and we're about to go down that space, but I think most advisors get a shock when they see the actual cost of an international trade.
Any other questions? All right, I think we're thereabouts on time, so perhaps if you could join me in thanking our two panel members. Thanks, guys.